Hi, Heather here with the Keys Group at Keller Williams Realty, and today I wanted to talk to you, to people watching, about financing in today's crazy market. And so to do that, I'm here with Dustin DeHart from Nova Home Loans, and I'm interviewing him to just get his feedback and see what's going on in the mortgage world. So I'd like to introduce you, Dustin DeHart from Nova Home Loans.
Hey, Heather, thanks for having me. Appreciate it. Hope you're doing well and safe. And we're getting through this mess and it'll clear up eventually, hopefully soon, you know?
Yes, absolutely. So I've known Dustin for 7 years. We've been working together. So I trust his opinion. I trust what he says. He's highly experienced. He's also your branch manager at Nova, correct?
That's right. Yep. Branch manager, vice president, senior loan officer. They give me a bunch of hats. So.
Awesome. So we're talking to the right guy. All right. So the first question, we're going to just kind of go through the different loan programs that are available and what type of buyers fit into certain loans. So
Sure.
Let's start with FHA. How about you tell me a little bit about what an FHA buyer looks like right now and what are their requirements for fitting into that product?
Sure. So FHA is for primary residence only. Now, typically an FHA borrower is normally a first-time home buyer, but it doesn't have to be. It's just got to be your primary residence. And one reason people will look to FHA is because it allows for a higher debt-to-income ratio than conventional loans will. It also allows for lower credit scores, or at least it did. Some things are changing, and we'll go into that. And you know, it's for a 3.5% down payment, so it's a low down payment option. And they're easier on seasoning issues, like let's say you had a bankruptcy or a foreclosure or short sale. You can get in with FHA quicker than you could conventional. Now there is a max loan amount in Clark County that's $345,000. Okay, so anything above that, you're not going FHA. Okay, so going back to what I said about credit scores, so really FHA doesn't have a minimum credit score requirement or HUD. Okay. But most investors or, you know, mortgage companies like Nova, they set their own overlays, right? So we were actually really aggressive. You know, when I first started at Nova, we were 600, then we went down to 580, and then believe it or not, we went down to 550, and now that's changed. So because of the coronavirus, you know, the mortgage industry is feeling a lot of pressure, and not getting too into it, but one of the problems is the forbearance stuff that's happening. Right, which no good deed goes unpunished and unintended consequences, basically. So what the problem is Heather, is now if, you know, so Ginnie Mae handles the FHA and VA loans. And so when the servicing part of this goes into effect, you know, the servicer basically takes the money from the borrower and gives it to the investor, but they actually pay the investor before they even receive the money, right? And, you know, and they do the servicing. We all know what a servicer does, and they handle the mortgage and field the calls and all that. But now all of a sudden, when millions of people are not going to be making their mortgage payment for 3 months, 6 months, or however long, that becomes an issue, right? And that's a liquidity issue. And, you know, a normal servicer is set up for the normal defaults or people that are not missing their payment. But when it's going to be millions of people, that's where it's got everybody all freaked out. Now, so that we've heard that, you know, some places were suspending FHA and VA loans. Look, there's a lot of rumors out there. I don't know what's true, what's not. All I know is what Nova has. We're good to go. We did install an overlay last week. So instead of the 550, 580, we've now gone up to 640, which isn't that big a deal in the grand scheme of things, right? And again, when the dust and Ginnie Mae has come out with some information recently, and it sounds like they're working through this issue. So I think it's going to start to really clear up, and, you know, and it'll be a little more relaxed here in the future. And FHA and VA loans should be good to go and shouldn't be any issues with those.
Okay. So some changes, but I think that things are going to settle down a little bit after.
But yeah, if we would have had this conversation last week, I probably would have had a different tone. But again, everything's so fluid and changes daily. You just never know what's getting thrown at us anymore. But it sounds like it's getting itself worked out.
Okay, excellent. And so let's see here. What are you seeing for FHA rates right now? I know that's kind of tricky because it changes day to day.
Yeah.
It's a roller coaster, but what would it look like compared to last week? Were they up or down?
Yeah, so another good question, and here's our other issue, right? So without getting too technical, within 3.5 weeks, we've seen more movement with mortgage-backed security pricing than we normally do in like 2.5 years, right? So extreme volatility, like literally, you know, a few weeks ago, we were at the lowest we've ever seen rates in the history of the United States. The next day, they just shot up, right? Because of all, with the uncertainty that's what's happening right now. Now, the problem right now is when you lock a rate, it's not actually locked yet. So it's not until we deliver that loan to the investor, then it's locked. So our capital markets team and other capital markets for investors do is they hedge, right? So, if the rates go up, they're fine. If they start to come down, they have some insurance on there. But when it goes so crazy like it has been, because there was no demand for mortgage-backed securities, but the Fed went in and they said, you know what, we're going to buy them all. And then they're buying more than they needed to, which sounds great because it's pushing rates down. But that's another issue that mortgage lenders are seeing is now that these investors are seeing this huge volatility, they're saying they're doing what's called margin calls and they want money now before it closes, right? So companies like Nova are cutting 8-figure checks every week. That can only last so long, right? So the good thing is the Fed, I know this sounds crazy. Rates are actually ticking up a little bit recently, but it's kind of giving everybody a respite and just letting the dust settle. They're going to come back in and buy them again, so it'll push rates down. But because of all that and the uncertainty with, like I said previously, with the servicing issues, rates went from low. Actually, I was locking in under 3% on FHA and VA loans to now they've pushed up a good point higher. And it depends on credit scores and other factors, but God, somewhere in the mid 4s to 5. It's crazy. So they're not where they should be. But again, this is all fluid. This is going to work itself out, and they will come back down, and we'll have these low interest rates again very soon.
Sounds like some overcorrecting was taking place.
It is. It's just to protect liquidity. So it's that or go out of business, and the latter doesn't seem like for most, right?
Yeah, no thanks. You don't want to be in business. So let's see here. Now let's get into conventional loans.
Sure.
And what does that borrower look like?
Yeah, so conventional loans are Fannie and Freddie loans, those government-sponsored enterprises. So if you're going to buy an investment property or a second home, you've got to go conventional, okay? But you can, people buying primary residences also use conventional loans. Now, some of the benefits of conventional versus FHA. Now, if you put less than 20% down, we all know you have to pay mortgage insurance, right? So with conventional loans, you can actually put as little as 3% down. There are some specific programs for Fannie and Freddie that give you a better rate with that 3% down than you would get if you didn't have this program. I'm not going to go into them all. They're income driven and zip code driven. But the mortgage insurance also is lower. But with conventional loans, the mortgage insurance eventually goes away, right, Heather? Once once you hit 78% of the original appraised value by either making payments or expediting them, it'll eventually drop off, right? Or you can even call up the mortgage company, the servicer, after 2 years. If you've got enough equity, you might have the ability to get it off then. But with FHA, if you put less than 10% down, you literally have that mortgage insurance for the life of the loan. So that's one drawback with FHA versus conventional. But rates are actually the one area that didn't get affected too much by all these margin calls and servicing issues are conventional loan rates. They're really low still, and we haven't seen them be impacted too much. They could be lower than they would be, if we weren't going through all this mess. So when it clears up, they're going to be, again, back to record lows, but we're almost there right now. So it's a great time for people. If you're still out looking to buy a house, if you can go conventional, you're going to be happy, put it that way,
Okay. And so what would a minimum credit score look like for a conventional
So it's 620
borrower?
Bottom line.
Okay.
So now that doesn't mean just because you have a 620 that you
Right.
get the loan. Unfortunately, we have to run it through a computer program. It's known as an automated underwriting system, right? So you got to have at least a 620 to get into that party, but it might not like you even if you have a 620, right? So sometimes
Mhm.
if you're putting a lot of more money down, then it might give you an approval. But if you're going like 3% down with a 620 and have nothing saved, you still might not get approved. So we might have to work on your credit score or put a little higher down payment down, or maybe have some reserves. There's ways to kind of trick the system to see what it likes, to figure out, all right, this is what you got to work on to get there. But 620 is the minimum credit score.
Okay.
That
And
has
then the same thing. What?
that has not changed yet. So,
Oh, okay, that's good. And then also with that comes, people who may have a bankruptcy or a short sale that they did. What's the time frame as far as being able to get back into that program?
sure.
Or do you have to wait?
So basically, the main bankruptcies are Chapter 7. So that's four
Mhm.
years from that discharge date. Okay, so
Okay.
bankruptcy discharge 4 years later, you can go buy a house using conventional financing. With a short sale, it's 4 years as well. With a foreclosure, it's 7 years. It's a long period. So it's, if you've had a foreclosure and you want to go buy a rental property, you're going to wait 7 years, right? Or a vacation
Yeah.
home or any type of conventional financing. That's why FHA and VA have much lower seasoning requirements than conventional loans.
Okay. And we went through the whole downturn of our market here in Las Vegas. And that
And we
was
don't get a whole lot of short
10
sales.
years ago. Yeah. So
Yeah,
those
that was
people
still
have kind of filtered
2009.
out.
Yeah,
Right.
well, it's crazy you say that, because literally, I mean, me and you've been doing this a long time, but it wasn't that long ago where literally, 8 out of 10 applications I took was like, okay, you need to wait one more year for your short sale season. I mean, it was
Right.
crazy. Or you got, 6 months and then you're good for your foreclosure or bankruptcy. We don't see a lot of that. I know more of the bankruptcy side than the foreclosure and short sale. See, I mean, we still
Mhm.
see it pop up nowadays, but yeah, that used to be for preponderance of people trying to buy houses, is getting through that mess. It's crazy, you know. Times have changed, but who
Right.
knows? Here we are. We start getting back to that.
Oh.
Hopefully we don't. I'm just kidding.
But we just don't know. That's
We
that's the
don't.
thing.
That's the
Depends on
problem.
how long people stay unemployed and
I know it's terrible.
and our just kind of stays here. So let's see here. Jumbo. Now let's talk about jumbo loans. So are
Yeah.
they still around?
Yeah, they
Okay.
are. They are. They have definitely tightened up. So
Mhm.
a jumbo loan's not Fannie or Freddie, right? So they don't follow those guidelines. So anything over, I believe it's 510,000. Got it. Sorry, I forgot. But that
All right.
conform loan limits,
Mhm.
that's considered a jumbo loan now. Okay, so if it's not in that
Mhm.
conforming loan limit, then you have to go jumbo. So every investor has their own guidelines, right? So, usually, when I have a jumbo loan, I try to pick the best investor with the best rate, and then I then look at their guidelines, making sure they fit it, right? Because it's not going off
Mhm.
of the normal HUD or Fannie or Freddie guidelines that we all know. They all have their little quirks, right? So that some might want 6 months reserve, some might want 24 months reserve. So it's a lot more detailed as a loan officer to make sure, yeah, you found them that rate, but you got to make sure they fit in that bucket. But they've tightened up. We're starting to see higher credit scores, more reserve requirements on different investments. But jumbo's still around. There are options that are called non-QM loans, which is a qualified
Mhm.
mortgage. That was like the bank statement loans, how there's stuff like that, or like we previously talked about, if you had a short sale or foreclosure, they maybe had options where you could get in with in 6 months or a year instead of waiting the 7 years.
Mhm.
Those pretty much evaporated, as far as I know.
Yeah.
I think we have one company left, but they're hanging on by a thread, because they're backed by Wall Street, and obviously Wall Street's having some issues right now and don't really have the appetite for these. So, not the end of the world if we put a little pause on bank statement loans. They will come back, but those are the ones that basically went away first. But jumbo loans, we still do jumbo loans. We're fine with them. They have tightened up. The rates for those have gone up. I
Mhm.
think across the board they're around 4.5, and where our pricing is right now, they should be in the low threes. So that's one thing they have done. So they just don't, they're trying not to bring in a lot of business. So that's kind of their way of backing people down a little bit. But again, when this clears up and things go back to normal, the rates will come down, and all of those overlays should pretty much go away.
Okay. And so what have you seen like the minimum credit score for those usually?
Yeah, so again, they're all across the board because, every investor has
Mhm.
their own
That's different.
guidelines. But typically, if you're going to get a good interest rate and go to one of the main players for jumbo, you need a good credit score, 700 plus. But there are options.
Mhm.
I mean, we have 620, 660. It just depends on the investor. But those lower tiered credit score investors, they're really not taking on jumbo loans right now. So if you're going to get a jumbo loan in this crisis right now, you probably need a pretty good credit score, so to have any shot at A, getting financing, or B, even getting some type of decent interest rate. So again, when the dust settles, all of those players will come back, and we have literally so many different programs. I mean, I have one for 5% down, no mortgage insurance, and that's still around, believe it or not. But again,
Wow.
fluid, that tomorrow it could be gone. I mean, we just never know with the way things are going.
So what happens in a case where you've qualified somebody and then the requirements change mid-contract? You're in a contract on a home, they're all excited, and then all of a sudden they say, "Oh, are you a non-essential business, or are you an essential business? Your work." Can they just cut in and say, you either qualify for this now or you're done?
Yeah, they can, because they're the ones lending the money. Now, typically, if you've locked the rate, you should be safe, right? And plus, they'll give you kind of a heads up, like, here you go, this is coming down the pipeline, be careful. So our capital markets team will tell us that, so we kind of protect our pipeline and lock them in. And if you're locked in, they'll, normally they're going to grandfather you into those old guidelines. But you did bring up a good point, with people losing their jobs. That's an issue right now that we're also seeing, because look, at the end of closing, the last thing you have to do as a lender is do what it's called a verification of employment, right? And you just typically that's just, no one even knows that. You just, our funder calls up Win and says, "Hey, is Heather still working there?" And they go, "Yes." And we're like, "All right, you're funded." Now that's the big issue that we're seeing. And I have, 85 deals in processing right now that are refinances from my team. And I'm looking through in there right now, and I can see about 30% are people that have been furloughed. So we're already reaching out to them and telling them what their issue is, right? Because and some of them don't understand it because they're still getting paid. I even brought up Win, because they're still paying their employees. But if you're not actually going to work, they don't, the Fannie and Freddie doesn't consider that to be still actively employed. Kind of like if you got hurt on the job, so you actually have to be working. So what we're doing is we're just extending locks for people and waiting for them to get back to work and having everything done. And then once we can get that final verification of employment ordered and everything checks out, then we fund the loan. But that's the other fallout that we're seeing with people. That's an unfortunate event of what we're seeing right now, and I think it's only going to get worse before it gets better, unfortunately.
Right. Yeah, because if we go on another 2 weeks without working, and now at this point we're at April 30th, so.
Yeah, like literally right before we started this, I had a past client email me all excited about a refinance. And it's weird nowadays, like my first question to somebody is, "Are you still working?" Right? Like I never thought like that's how I start a conversation, right? And she's like, "No, but I'm still getting paid per diem." And I'm like, "Well, fortunately, that's not going to work." And and she doesn't even know when she's going to get back to her. And these are the true, real, deep issues that are affecting, people right now. It's not good. It's to refinance somebody, Heather, and especially in this time, it could really help them out, to lower their payment, or pay off some debts and just get, even missing 2 payments is a big help for people right now. So it really breaks my heart that this is happening to people, and like we can't just step in. And I just wish Fannie and Freddie would come out and, ease up a little bit on this, but that hasn't happened yet. So unfortunately, it is what it is. And again, it's fluid. It could change, it could not. And, people will start getting back to work and we'll get normalized again. But that's a big issue that's facing everybody in the mortgage industry right now. And those poor clients that thought they were getting this lower payment, but B, they don't even have a job right now. So I feel really bad for everybody that's going through all this right now. It's horrible.
Yeah, I wish we could just fast forward to 3 months from now and get through this at least. So
and go to a bar and watch some sports.
Absolutely. Let's see here. Okay, so VA loans. Any changes in VA loans? And
not on our end. And again, I'm not.
Okay.
Again, there's a ton of rumors out there. I've heard some have stopped VA. I don't know all the rumors. Nova, we're good to go on VA. We're fine, and thank God, because to be able to help a vet, it's the best loan out there. So right now, VA is good to go, and I don't see that changing.
Great, good news.
Yes, a little bit.
Yes. Okay, so we talked a little bit about credit issues and stuff like that. You have a credit repair department. Can you tell us a little bit about that and what that's looking like nowadays?
Yeah, you bet. So it's not credit repair. We can't have credit repair. I know, it's okay. It's called credit services. And it's free of charge. And that's why we can't, we couldn't have a credit repair company and a mortgage company. And quite frankly, I think most credit repair companies are kind of shady and just take people's money. And, they do a bunch of stuff for them. Like, that's good. Your score's up, but they put you on an authorized card. They disputed everything and they come back to me. And then I have to unravel all that, and their score is back to where it started from, and they paid somebody $2,000 to do all that. So, yeah, I believe we're the only mortgage company in the country that offers this, and we've been doing it for years. And something, one of the most proudest things I at Nova that I have is credit services, because I know, Heather, we've had mutual clients that have used it, right, countless times. Yeah. So yeah, it's simple as this. I mean, and we use it in many different facets, but the most preponderance would be, hey, you've got a low credit score, you don't qualify for anything right now, right? But good news is I have a credit team, and we have actually 16 different FICO processors. I think they all have at least 15, 20 years experience in credit. Nevada has 3 on their own. So I simply email them the loan number. They look at the credit report, they analyze it, they run FICO simulators, and they tell them what to do, right? It's a detailed email on exactly what you need to do, followed by a phone call to go over everything. And then they're in a plan, basically, right? And my credit team, every 30 days, or if it's condensed, right? If it's only going to take 2 weeks, every 5 days, we're going to be calling you. But they do what's called soft checks, so not a hard hit on your credit report. And then all of a sudden, I'll get an email from credit services that said, all right, the Smiths are a 660 now, they're ready to go, right? And then I look them up, I call them up, and I'm like, oh, that's great. We're working with Heather, and we get them out, we find them a house, right? But look, some people use it for a better interest rate, right? Let's say you're at a 720, and if we can get you to a 740, you can get an eighth of a point better interest rate. And my credit team looks at your report and goes, hey, just pay this credit card down to this amount. You're good to go. We rapid rescore you, and you just got an eighth of a point better interest rate for that, right? And they also do other things to help us, when there's problems with the automated underwriting system with certain things. It's just a great department to have. It's free of charge. We've helped thousands upon thousands of families get into a home or refinance a house that may not have if they didn't go to Nova Home Loans just because of credit services. It's a fantastic program.
Yeah, and that it's free. I mean,
that helps too.
People don't have to worry about somebody's got an in for this or that or trying to take advantage. It's here the facts.
And it doesn't mean you have to use us. We get your score up. We have to earn your business. You know what I mean?
Right. Excellent. So let's talk about appraisals.
Yeah.
What are you seeing in appraisals right now? Because I just got an email from Wells Fargo that said that they're not doing interior appraisals anymore. That was this morning.
Really?
What are you seeing?
Wow.
Yeah.
Well, not again on our end. It's business as usual. However, not only the coronavirus, we're just completely overwhelmed with files right now. So when we're the busiest we've ever been, and most lenders are right now, just because of the low interest rate environment. So it's just millions of refinances that are available right now. And, just going through our database, we just couldn't keep up. So appraisers are busy as well, right? So their turn times have increased. What we've done on our end, we own our own appraisal management company. I don't get to pick appraiser, right? You know that. But
Right.
the appraisal management, so what I do as the branch manager have the ability to staff the appraisal, staff our appraisers, so I give them a list of good appraisers, and then it goes kind of a round robin. I don't care who I get, they're all great. But yeah, I've heard some that are a little lenient on going into houses, but at the end of the day, there's a paycheck involved, right? And that's how they get paid. So as far as I know, all our staff is full systems go, and we're getting they've kind of doubled our turn times, but we're seeing them come in way sooner than that. So I haven't seen a huge issue with appraisals right now, and I don't think that's going to change anytime soon. And another thing that people aren't aware of, a lot of times you don't need an appraisal, and especially lately with on a refinance, especially because of our increase in property values. When I've talked about that automated underwriting system, Heather. More often than not, we get what's called a property inspection waiver, where you don't even need one, right? And we can even get those on purchases. Now, if you're putting 5% down or something like that, you're going to need one. But it's a certain loan to value, and it depends on the address. For whatever reason, sometimes it doesn't like an address versus, I don't know why, it's a computer program. But a lot of times, if you're putting enough money down on a purchase, you won't even need an appraisal nowadays, which is great. And they are looking at, because of the coronavirus, it's case by case, where they can just do a drive-by instead of an internal one, but that's kind of underwriting discretion. So we're still kind of working out the kinks with that. But right now, appraisals, we're not seeing a huge issue with right now. So knock on wood.
Good. Yeah.
Right.
That's good. Something stable in our lives.
Yes.
Appraisals. Okay. And
I can't make them come in at value, though. So.
Yeah, still gotta have the value. Exactly. Yeah. Let's see here. And then, so let's see here. Do you have any kind of special loan programs for teachers or some other professions in our community? Can you tell us a little bit about those?
We do, and you know what? There should be more of them. That's always kind of irritated me. We don't have a specific one for teachers and doctors and parents, you know what I mean, and fire, all of them kind of wrapped into one. They don't. There isn't one. We do have doctor loans. You have to be within 10 years of residency, so it's not like for a doctor that's been around for 20 years. But a newer doctor, you can actually go up to like $1 million with 5% down with no mortgage insurance with a really good interest rate. But the one I really push, and it's a great program. It's for teachers. It's still around. It's a down payment assistance program. I actually looked at it today. The rate, believe it or not, it's 2.75%. Can you believe that?
Wow.
And on top of that, you get $7,500 towards your closing cost and down payment. And it's kind of like a forgivable second. I think on the teachers program, it's 3 years. So if you've been in the house, haven't touched the loan for 3 years, they forgive that $7,500. And you have a rate under 3%. It's a great program. So if you're a teacher and you're listening to this, call us up.
Get on it.
It's a fantastic loan program. Yeah.
That's awesome. And the last question I have for you is now a good time to refinance?
Yeah, yes.
You still have a job.
Yes, if you have a job. Look, everybody's situation is unique. But, I'll tell you, Heather, this time last year, out of the 10 people I spoke to about a refinance, I'd say 20% there was a benefit for, just because the rates were higher, and now literally it's 85%, but there's, there's a lot of, again, refinancing covers multiple things, right? I mean, the most prevalent one is just a rate and term refinance, right? We just lower your interest rate, right? But sometimes, even if we don't lower your interest, like I just literally closed a gentleman last week where his interest rate didn't really go to, I think it was about the same as it was, but we ended up paying off about $70,000 worth of credit card debts and other stuff that equaled to $1,800 in payments going out every month. So think about that. I wiped all that away because the mortgage payment went up like $250 a month, right? But he's saving $1,700 on other stuff. So I'm like, I get it. You're not going to apply all that $1,700 to your home loan, but let's just say you took 400 of it and you still got $1,000 or $1,200 that you're cash flowing that you can put in the bank, and you'll literally, now you're debt free with all that stuff. And by applying just a little more to your home loan, you'll have your house paid off. I think it was 9 years sooner than he would have by not refinancing. So he got debt free, and he's going to pay off his home sooner by just doing that, and now stick $1,000 more in the bank every month. So, those are the home runs, but the debt consolidation loans could really save people, especially in times like right now. But, believe it or not, which I find interesting, is a lot of people are on 15-year loans, even in this time right now, like they're fixed income or their job's not being affected by this. And they're like, hey, I'm probably not going to ever see this rate again the rest of my life. And they're probably right. So why not, right? My payment maybe goes up a little bit, but I got a rate under 3%, and I've just shaved off 11 years off my home loan, and a lot of, and we did the beginning of this, we talked about FHA loans, right? So if you got into an FHA loan, again, you probably have mortgage insurance for the rest of the life of the loan. So if you've got some equity now, even if it's not, 80% loan to value, we could get you into a conventional loan. It should lower your mortgage insurance, hopefully lower your interest rate, but eventually that mortgage insurance will go away as well. So that's a popular one we're seeing with VA loans. They offer it's basically a streamlined refinance. You don't even need any income. It's basically you fill out an application, we lower your interest rate. So yes, to drag that question out very long, it is a great time for people to refinance. I call it a mortgage tune-up, right? We get our cars tuned up all the time. Probably should get your house tuned up, right? And look at that. If I don't see a benefit, I'm going to be the first one to tell you, sleep like a baby. You're good to go. You don't need to touch this. But I tell you, mainly nowadays, everybody is usually benefiting from a refinance right now. So, so if you can just even lower your rate or get rid of mortgage insurance or pay off some debts or get into a lower term, really sets you up for retirement, getting that house paid off quicker for sure.
Yeah, it's a great strategy tool to help you strategize your future and debt, because it's part of life. Debt.
It is. You need a house, so
yeah,
it's nice to not have a payment on that when you get older. So
yeah, absolutely. So, any final words of advice? Anything you want to?
Yeah, look, what's funny is, we were the mortgage industry was the villain the last recession, right? We caused all that. Now we could really be the hero, and again, I told you some of the issues we're facing, but we're going to be fine. And the federal government knows that. So they're not going to let us fold. They've already seen the unintended consequences with certain things, and they're already stepping in to help that out. Rates are phenomenally low. Once this all settles down, they're going to go even lower. And that's just my opinion, but rates are going to be low for a long time. I get people are probably sitting on the fence right now. I think you're seeing that, right? Of people buying a house. And God, I don't blame them, but and maybe sit on the sidelines for a while. But one thing about a crisis, there's always opportunities, right? Even like the stock market right now, right? I mean, maybe a good time to get into that. But with real estate, pick the spot. Maybe we sit on the sidelines for a little bit and then see where the dust settles and then get in. But we're gonna be fine. And if you can benefit from a refinance, I'd love to help you out with that, because there's a lot of people that are benefiting. It's really, really saving them right now. But, again, our real estate market, my opinion is it's probably going to take a little hit from this. I mean, how is it not, right? With just the huge unemployment and everything, and, everything else that's happening. But we're Las Vegas. We're going to get through this. And, once this clears, because we were on a trajectory this year, right, Heather, of having a really damn good year. And when we get back to those, what led to that, which we will soon, everything, again, it's all unknown. So we don't know how long this is going to take. But once we get past this, we're going to have a fantastic real estate market again with low rates. it's going to be a great time to buy, and it still may be right now. It just depends on your situation. But talking to a professional like you and me, and we can kind of guide you in the right direction.
Yeah, absolutely. So on that note, I just wanted to leave everybody with this fact that I found on the MLS today, that our market, even though it seems like it's down, we still had 1,031 homes go into contract in 2 weeks. That was a 2-week period. So people are buying homes.
That's amazing.
It's just, you got to be smart about it and work with the right professionals. So I appreciate your time today.
Yeah, thanks, Heather. Be safe, and appreciate working with you all these years, and God bless you.
Thank you. Same to you. And we'll connect afterwards when all this blows over.
Absolutely.
And celebrate. Okay.
Take care. Thanks so
Dustin.
much. Bye.
Okay, bye.